What's up everybody, welcome back to the channel, it's great to see you here, let's get right into it. Your crypto portfolio strategy for 2025. A lot of people just throw money at whatever coin is trending on Twitter, cross their fingers and hope for the best. But here's the thing, that's not a strategy, that's just gambling. And if you're serious about building real sustainable wealth, you need to approach this with a plan. A solid, well-thought-out plan is the difference between someone who gets lucky once and someone who consistently builds their net worth, regardless of whether the market is going up, down, or sideways. The crypto market is notoriously volatile, we all know that. One day you could be up 50% and the next, you could be staring at a sea of red. That's why having a robust strategy isn't just a nice to have, it's absolutely essential. It's your roadmap that guides you through the chaos, helps you make logical decisions instead of emotional ones, positions you to capitalize on opportunities, and protects your hard-earned capital. Without one, you're just navigating a minefield blindfolded. As we look ahead to 2025, which many analysts are predicting could be a pivotal year for the crypto space. Alright, first up, and this is arguably the most important principle in all of investing, not just crypto diversification. I know you've heard it a million times, but people still get this wrong. Diversification in crypto doesn't just mean buying Bitcoin, Ethereum and calling it a day. That's a start, but true diversification goes much deeper. You need to think about spreading your investments across different categories within the crypto ecosystem. Think of it like building a well-rounded sports team. You don't want a team of only quarterbacks. You need different players with different skills. In crypto, this means having exposure to large-cap projects. Bitcoin, example of large cap, they are the bedrock of your portfolio. Then look into mid-cap cryptocurrencies, established but with room to grow, more risk than Bitcoin but higher potential upside. Beyond that, allocate a smaller portion to small-cap coins, micro-cap coins, potential 50x or 100x winners, highest risk part of your portfolio. This is your venture capital wing. Expect most to fail. Don't just diversify across market caps, diversify across sectors. Layer 1's Layer 2, scaling solutions, DeFi platforms, GameFi, AI-related crypto projects, real-world asset or RWA tokenization. Each sector has its own cycle and reacts differently to news. For example, regulatory crackdown on DeFi might not hit GameFi or AI the same way. Spreading capital across verticals insulates your portfolio. Rule of thumb, 50% large caps like Bitcoin and Ethereum, 30% promising mid caps, 20% speculative small caps and sectors. Okay, so you've built a beautifully diversified portfolio, that's great. But you can't just set it and forget it. That brings us to our second secret, regular rebalancing. Think of your portfolio like a high-performance car. The market is constantly moving, and over time, your initial allocations will drift. Let's say one of your small-cap altcoins has an incredible run and goes up 10x. Suddenly, that small 5% portion might balloon into 30% of your holdings. This feels amazing, but it also means your portfolio is now more concentrated and exposed to risk from that one asset. This is where rebalancing comes in. It's the disciplined process of periodically buying assets or selling assets to restore your desired allocation. In the example where your altcoin grew to 30%, rebalancing would mean selling a portion to take profits and bring it back to your target, say 10%. This is a simple concept, but it's psychologically very difficult. It forces you to sell your winners, but what you're actually doing is systematically buying low and selling high. So how often should you do it? There's no single right answer, but a common approach is to rebalance on a set schedule, for example, once every quarter or twice a year. The key is to choose a strategy and stick to it. Set a schedule, put it in your calendar, and treat it like a non-negotiable appointment with your financial future. This discipline will pay massive dividends in the long run. Now let's talk about something that isn't as glamorous as finding the next 100x coin, but is infinitely more important for long-term survival: risk management. The number one rule of risk management in crypto is so simple. Only invest what you can truly, genuinely afford to lose. I need you to be brutally honest with yourself. If your entire crypto portfolio went to zero tomorrow, would you be financially devastated? Would you be unable to pay your rent, buy groceries, cover an emergency? If yes, you're invested too heavily. Crypto shouldn't come from your emergency fund. This capital should be considered speculative. It's money for high risk, high reward after other bases are covered. This mindset shift lets you act with logic, not fear. When you're not terrified, you're less likely to panic sell at the bottom. Another powerful tool is the stop-loss order. A stop loss is an order to sell a crypto once it hits a set price. Example: buy at $100 and you accept a 20% max loss set stop loss at $80. If it drops to $80, your position is automatically sold. That stops a 20% dip from becoming an 80% catastrophe or a 90% catastrophe. But be smart where you place stop losses. Too tight and normal dips will stop you out, then you'll watch the coin recover and rally without you. Using stop losses is like wearing a seatbelt. You hope you never need it, but if you do, it can save you from a devastating crash. Good practice. Check recent price history and place stop loss below a recent support or significant low. That gives the asset room to breathe and avoids premature sales. This next secret is one of the simplest to understand but one of the hardest to practice in the adrenaline-fueled world of crypto long-term holding: hodling. The strategy is straightforward. Identify strong projects with real-world use cases, a great team, solid tokenomics, then hold for the long term. Think years, not days. This is the opposite of day trading. You're not scalping small daily profits. You're investing in the underlying technology. Most people who actively trade end up losing money. Chopped up by volatility, eaten by trading fees. Long-term holding lets you ride out short-term noise. You're betting on the long-term trend examples. Bitcoin, Ethereum. So, what makes a strong project? Do your due diligence. Don't buy because a celebrity tweeted it or because it has a funny dog mascot. Read the white paper. Understand the problem it solves. Who is the team? Their background and track record. Check community engagement on Discord and Telegram. Tokenomics, fixed supply or inflationary. These are the questions to ask. You're investing in a business, not a ticker. This approach requires huge patience. There will be times your portfolio is down 50% or more. Your research and conviction matter. Biggest gains come from patience and conviction, not chasing short-term pumps. Finally, we arrive at the fifth and final secret. It's the one that ties everything else together: staying informed. The crypto space moves at an absolutely breakneck pace. A technology that was revolutionary 6 months ago could be obsolete tomorrow. New narratives, new regulations, new competitors. You simply cannot afford to be passive with your knowledge. Being a successful crypto investor means being a lifelong learner. You have to be proactive about keeping up with the latest news, trends, and technological developments. This is your ultimate edge in the market. So, where do you get this information? You need to curate a reliable set of sources. Follow reputable developers on platforms like X. Follow reputable researchers on X. Follow reputable analysts on X. Subscribe to high-quality newsletters that provide deep dives. Listen to podcasts with project founders and industry experts. Join the Discord communities for projects you're invested in. Join the Telegram communities for projects you're invested in. Get information straight from the source. Build your personal intelligence network. One of the most critical areas to watch is the regulatory landscape. Government decisions around the world can have a massive and immediate impact on the crypto market. News about a potential ETF approval, news about a crackdown on certain types of tokens, news about new tax guidelines. You don't have to be a legal expert, but have a general awareness of regulations in the United States. This will help you anticipate potential market-moving events and adjust your strategy, rather than just reacting after the fact. Ultimately, staying informed empowers you to make proactive, intelligent decisions. Dedicate a small amount of time each day or week, maybe 30 minutes a day, to conscious learning. This consistent habit will compound your knowledge over time and give you insight and conviction the average, uninformed investor can't compete with. And there you have it, the 5 essential secrets to building a powerful and resilient crypto portfolio for 2025 and beyond. From diversification and rebalancing to risk management, long-term holding, and staying informed, these principles are your blueprint for success. Remember, building wealth in crypto isn't about getting lucky with a single moonshot. It's about applying a disciplined, strategic approach over the long term. It takes time, it takes patience, and it takes effort. But the potential rewards are absolutely worth it. Now I want to hear from you. What are your personal crypto portfolio strategies? Are there any core principles you follow that I didn't mention? Drop a comment down below and let's get a conversation going. If you got any value out of this video at all, make sure you subscribe to the channel and hit that notification bell so you don't miss any future videos. Thank you so much for your time and for watching all the way to the end. I really appreciate it, and I'll see you in the next video.